convertible bonds. This is an area of Wall Street that is not talked about very often, but it is quite interesting.
Convertibles have actually been around for 300 years, funding growth and innovation. In fact, the first one was the British East India Company issued bonds convertible into sovereign debt. And then in the first half of the 1800s, convertibles were issued to finance the early railroads and Western expansion. Let me just give you a few comments about their long-term return, how they've done this year, and then we can talk about some specific inflationary environments. So, convertible returns, the asset class has been around forever, but we actually have return information for the entire asset class back to 1973, right? So the indices began about 1987, but there were studies done by Ibbotson Associates that basically had the annual returns. And so we can plot the return of convertibles over time, and basically it's neck and neck with the S&P 500 since 1973, but with only a portion of the volatility. Right? We looked at 5 periods of inflation from 1973 to 1985, when peak CPI hit 14.8. 1987 to 1991, CPI hit 6.3. We looked at 99 to 2000. That was more of a wealth effect type of inflation. The CPI only hit 3.8, but it was a spike in it. 05 to 08, right? So just prior to the financial crisis, inflation actually hit 5.6%. And then 2000 to 2022. Well, basically we did the analysis back in May at 8.6. It's a little bit higher than that now. And in these 5 periods, convertibles outperformed both equities and core fixed income, right? So convertibles, you look at that all of those 5 periods, they returned 10.8% versus the S&P 10.3%, right? And core fixed income, bonds came in about 7.1%. So really strong outperformance when you look at, entire inflation cycles. For bonds, convertibles have less interest rate sensitivity, as I mentioned before. That equity option actually increases in value with rising interest rates. And so that keeps the exposure to rising interest rates low.